The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
When bands and performers come to Seattle, they send out a document that spells out what they want to eat and drink and how the stage should be set up. A whole list of requirements. Some paint the dressing rooms. Some performers ask that the dressing rooms be repainted. Even if they were repainted by the previous performer, they want them painted. Maybe they want them painted white. Some performers have asked for a bucket of ice and a fifth of Jack Daniels. One performer asked for 2 cartons of cigarettes. I'm sure that they weren't the only one. And the stage people will talk to the previous venue and ask, do they have cigarettes left? And the previous venue would say, oh yeah, we got a couple cartons of cigarettes because they were out when they arrived. Well, it turns out that performer read somewhere that if she only took 1 puff of a cigarette, she wouldn't get cancer. So she would light a cigarette, take 1 puff, and put it out. So sure enough, when she arrived in Seattle, the stage manager had called the previous stage manager and found out she had 2 cartons of cigarettes. Didn't buy cartons. She was upset, really upset.
Mike, I knew a guy that used to like to do heroin.
Yeah.
And he said, don't you worry about, someone asked him, don't you worry about getting addicted? He says, no, I've had friends that have done it for 30 years and never gotten addicted.
Some of the requests are longer, some are shorter. Back in the time when Van Halen arrived in Seattle, we just played Jump by Van Halen. They were the band in the 70s and the 80s. They were a significant, flamboyant, extravaganza. Instead of having a 3 or 4 page contract, though, they had a 53-page contract they had. 53 pages. Other people had 2 or 3. The Van Halen contract was 53 pages. Things like, on even days, they were asking for roast beef or fried chicken or lasagna with sides of Brussels sprouts, broccoli, and spinach. That's what they wanted furnished. On odd days, steak or Chinese with green beans, peas, or carrots. Under no circumstances were they to have paper or plastic plates. They wanted the real thing. And for munchies, on page 40, they wanted potato chips, nuts, pretzels, and M&Ms. With this warning, with a huge warning, in caps, absolutely no brown M&Ms. Absolutely no brown M&Ms. So why the hang up on brown M&Ms? Was it a bad experience? Why would they make some poor stagehand pick out brown M&Ms or make the caterer pick out brown M&Ms? When that contract got leaked to the press and to the critics, the response was it was really a classic case of rockstar excess. It was, from time to time, that Van Halen would leave the dressing rooms trashed. And here they wanted absolutely no brown M&Ms. So it was ascribed to the fact that they were just rock stars, they were spoiled, it was excess. That's what it was called. But the reality was very, very different. The Van Halen show was an extravaganza. It had a colossal stage set, booming audio, spectacular light effects. And all of that required a great deal of structural support, electrical power, and many arenas where they played were outdated. In Van Halen's contract, it spelled out point by point the instructions to ensure that the promoters provided enough physical space, that the load-bearing capacity was enough to handle their performance, and that they had enough electrical power for that spectacular light effects and stage set. Point by point, it spelled it all out. They wanted it all spelled out because they didn't want anyone to be injured or to be killed. And there was a danger of that. If something falls apart, somebody can really get injured, not just in the band, but some of their fans as well. So when Van Halen arrived in a new city, how could they be sure that their instructions were followed in detail? The brown M&Ms. David Lee Roth, the lead of Van Halen, as soon as he arrived, the first place he headed was to the dressing room to see if there were brown M&Ms. And if there were brown M&Ms, he knew that the stage crew had not read the contract in detail and they needed to do a serious line check. They had to go through each and every one of the points to be sure that the stage was large enough, to be sure that the load-bearing capacity was going to meet their standard, to be sure that they had enough electrical power. They had to make sure of all that. And once they went through that point by point, if it wasn't enough load-bearing capacity, they would get the stage crew to build and increase the load bearing. They would bring in extra power if they needed it. That's what they did, and the M&Ms were their indication of whether the stage crew had actually read the contract.
Mike, the point of how important that is my daughter was at Bumper Shoot years ago, like 2, 3 years ago, and the stage collapsed. And people got pinned and got hurt. She was right in front, and she was like the people right in front of her collapsed on her. She didn't get hurt herself, and her friends didn't get hurt. But the people in front broken legs, broken arms.
You hear about that. Almost every year there's at least one performance or two performances where somebody gets injured or hurt. With Van Halen, they had the brown M&Ms. And to cover it up so that people would know what they were doing, they would trash the dressing room. So that people thought, it was the eccentricity. That was what they did. So the question is, they had their own check to make sure that point by point everything was followed. They didn't just ask the stage crew, did you read the contract? Did you check all these things? No. They made sure when they saw if there were M&Ms, they didn't have to walk through everything and check everything if they saw no brown M&Ms, because they knew that the contract had been read and point by point everything had been answered. But when you listen to financial advisors or when you listen to clients of financial advisors, how do they know what the financial advisor is basing their recommendation on? How do they know that they stand by their word? How do you know what you're really paying? What are the mutual fund expense ratios, but does that add in the trading cost and the cash drag? Estimates are that's a total of 3% added in addition to which the financial advisor. How do those fees affect the return? How do you know when an advisor says, this is what we project you'll do, here's where we think you'll go? How do you know that they can even meet that? Almost every financial advisor these days does a financial plan, and they spell it out. This is going to be how you do, how everything works. Is there any verification? No. You get your plan, you get to see it, and it looks wonderful. I remember in the beginning that we were going to do some financial planning. We had a 400-page contract the first time. It was beautiful. It was the most expensive financial planning software that existed in 2005, and it was awesome. It was over 400 pages. It had all sorts of pie charts and circular graphs and line charts, and in a million different colors. It was so impressive, but when I took it home to read it, statistical assumptions were wrong. But how do you know when you get a plan, no matter how beautiful, how wonderful, how great it looks, how do you know that there's going to be a performance there? How do you do your own brown M&M check? Do you just believe that the person's going to do it? Van Halen taught us you can't just take the word of the stage manager who says, oh yeah, we got everything set up for you. No, they wanted to know for sure. They wanted to know that somebody had read the contract and had point by point taken it seriously. I think for investors, it's important to really focus on how do you know what an advisor does. For us at Adams Financial Concepts, we know what you started with. We know and can publish our financial returns. We can show what we've done for our clients. And our financial returns are shown in a composite of client performances. We start with clients that have been with us from before 2005 to clients that have only been with us for 1 month. All those are averaged together. Clients who have passed away and their accounts come to an end, those are discontinued, but they're in the performance all the time that their account was open. That's published. That you can see. That's our M&M. That's our status to say, this is what we do. There's no telling you this is what we do. Just trust us. But isn't that what other financial advisors are asking you to do? Just trust us. Just trust us. We do really well. Jackson National Life and the data's old, but Jackson National Life, ask financial advisors how many beat the market? How many beat the S&P 500? 75% said they did. Not a surprise, and even though the data is old, there have been other studies that have shown that if you ask how many people in a room are better than average drivers, 75% of the people will raise their hand. If I'm in that room, I'd raise my hand. I don't know if I'm better than average.
You're worse than average. I've driven with you.
Don't go away. We've got more to cover. We'll be right back after this commercial break.
About Money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
Jump by Van Halen.
So back to Mike's driving. He thinks that a stop sign and a red light are just a suggestion.
Oh, yeah. You don't believe everything you read, do you?
No. And half of what you see is my mother used to say.
You know, I think it's so important to really understand things like the brown M&Ms. And Van Halen is one group, and I use it as an illustration because I love the illustration because it points out so clearly that it's important not to just listen to what people say. You know, what's the old expression? What you're doing speaks so loud, I can't hear what you're saying.
Well, you know, a gentleman I was trying to make a client about a year and a half ago, he ended up going with a friend, his fancy advisor, and I asked him, well, what are the returns I'm going to... He said, you know what he said? 5%.
Yeah.
I said, wait, they're big fancy, that's all you 5%? I said, you're paying 1% or 1.5%, and you're getting 5%, so... I
mean, that's the average of most financial advisors. Study after study after study shows that advisors are producing a 5% return. And, you know, the difference between 5% over 20 years and 15% over 20 years...
Even 8%
or even 8%
is a huge difference.
It's a huge difference. It doesn't sound like that big.
No, but when you compound that 3%, Mike, over a 30-year period, right? I mean, look at a guy like who was a value investor, one of the great ones, John Neff. And when you compare his 1965 portfolio against the S&P 500, he only beat it by 3 percentage points. That's it. But for 30 straight years, $10,000 invested went to like 600 and some odd thousand, where the S&P was like 490 or something.
So as a rule of thumb, if you look at something over 25 years, compare 5% to 10%, that's only a 5% difference. But the difference in 100,000 invested at 10% will be 3 times what it was at 5%. And at 15%, it'll be 3 times more than it was at 10%. And at 20%, 3 more times than it would be at 15%. So think of what a 15% to a 5% return is. You know, it doesn't seem like much, 10% per year, but the difference is tenfold.
We can look at the actual numbers.
Just
pull out the old calculator. So if you had $100,000 invested, 5% for 30 years, 100,000 years, you'd have $432,000.
Okay.
So we take the same 100,000 at, just let's do 8%. Keep things, right? $1,006,265.69.
So 2.5-fold.
3% difference.
3% difference.
You compound that, compounding of that 3% over 30 years is a huge difference, a huge number.
Yep.
So you got roughly almost $600,000 more in your bank account.
Alfred Einstein called it the
8th wonder of the world, right?
Yep.
Yeah.
8th wonder of the world.
Nobody knows how it works, but it just works.
It does. You know, and as you're going through this period of time, I mean, Josh Brown, you've probably seen him on TV. He wrote a book called Backstage at Wall Street. On page 65 of the book, one of my favorite quotes says, most of the brokers I know, and brokers, he means financial advisors, most of the brokers I know and have met over the years are phenomenal, world-class salespeople.
Mm-hmm.
But a great many of these security selling savants don't attain the knowledge necessary to actually accomplish anything for their clients. Selling one's expertise is much easier than actually developing an expertise, especially as it pertains to investing. So they're world-class salespeople. They're sophisticated, and they will tell you what you want to hear. I can remember going through training when I went through training, and they said, okay, if someone calls in, and in those days people would call in to the stock brokerage offices, and they would say something like, what do you think of AT&T? The right answer was not to give your response, but to say, are you a buyer or a seller?
Mm-hmm. Mm-hmm.
And then customize your answer to whatever they said. If they said a buyer, you could tell them how great AT&T was and shouldn't you open an account and buy AT&T. They said they were a seller, say, What do you have? Is it in a certificate form? Can you bring it in and we'll sell it here? I mean, that's how the training goes for financial advisors.
My training went like this when the market shifted from, I started in 2008 and the market shifted and started to get better. And so they went from selling this product to that product. And my manager used to say, every product has its day.
Yeah.
Right?
Yeah.
You go from selling scarcity when things are bad, you sell fear. And when things are good, you sell, well, things are good.
Yeah. So in my class, there were 41 who went through training with me at Payne Weber. We would spend 2 weeks in San Mateo at the trainings class, come back to the office for 2 weeks, then there for 2 weeks, then back there. And you got to know 41 people you got to know pretty well. And at the end of the 6-week period, there was an informal voting of who would not succeed in the business. Because in those days, 1 out of 3 would make it. Maybe not that many.
1 out of 3?
1 out of 3. Maybe it was less than that.
No, it's less than that. It's way less. It's 1 out of 10, Mike.
Okay.
It's 1 out of 10.
That's what there were in my class, because by the beginning of 1988, there were only 4 of us left. But when the vote came in, I was one that was voted not to succeed. Mm-hmm. Because when they said, when people call in and ask your opinion of a stock, I said, I just can't do that. If I believe the stock sucks, I'm going to say that. If I believe it's a great stock, I'll say that. But I can't be there to sell.
As if there's a funny scene. I don't know if you ever watched The Sopranos.
Yeah.
But the one character, Christopher Maltasani, they send someone in to take his Series 7 so he can run a brokerage and they can run fake accounts, right? So they have these stockbrokers in a room, boiler room, and this guy calls in and says, I want to buy, they're pushing this stock called Webistics, right? They're told to push this stock, right? So they're sitting in the office, and he's got these 2 thugs in the office that are supposed to be the compliance officers, right? And so the guy calls in and says, I want to buy the Webistics, and the guy, the broker picks up the phone. Why do you want to buy that? It's a terrible stock. Two guys come over to him and beat the crap out of him. No, we're pushing that stock. We're pushing that stock. And that's what they did.
Yeah, that's, and it came back to the fact that it was never a question of do what's right for the customer, do what's in the customer's best interest. It was do what you needed to do to sell the product.
Yeah, but Mike, let's. I've always wanted to confront this in the industry. The industry is set up for people to fail and cut corners.
Yep.
Right. It has a 90% failure rate.
Yeah.
Right. 90% failure rate. And so you're coming into this business and they're telling you, your whole, they used to tell us, your thing is cash flow and client acquisition, So you got to do what you got to do to survive, just to make it so you can eat.
Oh, yeah.
Right? Unless you have a huge bankroll behind you. But back then it was 100%. I don't know for yours, mine was 100% commission based. They gave me nothing, zero. They said the sale was, when they came in, was, you get all these training allowances. And I said, they're going to give me 40 or 50 grand a year to keep myself going. So I said, no. The training allowance came if you sold something. So if you sold something worth $1,000, they'd give you like an extra, say, $400. But if you didn't sell anything, what's your training allowance? Guess. Zero. Yes, zero. A big zero. So I'm wait, where's all the money that's supposed to be helping me train? You haven't sold anything, so you don't get it. And guess what? Next year, if you don't sell anything and get to this level, that first year's training allowance is gone. So now you're making less because you're supposed to be making more this year. That's how the industry works.
So we had a $1,000 a month payment that declined $100 a month for 12 months.
Yeah.
I mean, and the whole deal was if you didn't do $25,000 in commissions in the first 6 months, you were fired. And if you didn't do $100,000 in commissions in the first year, you were fired. Mm-hmm. And maybe it was 2 years. I don't remember. But I remember everybody said you have to do mutual funds. And this is at a time when mutual funds were paying 4 to 8% up front.
Yeah.
And after 1 month, I said, I can't do this. This is not the best thing for clients. I said, I am going to sell individual stocks and bonds to clients. And if I get fired, if I can't make the $25,000, then so be it. Yeah. I would be out of the industry.
Right.
And I just barely made the 25. I just barely made the 100,000. Mm-hmm. But 37 of the 41 classmates of mine did not make it.
Oh, yeah.
But they also went through October of 87, and that was a dramatic time. I remember one of the people that went through training sat and stared at his phone all day long. He couldn't even lift up the phone.
300. You've heard of the 300-pound phone, haven't you, Mike? But the thing is the industry is set up for failure. We'll pick this up and we'll come back. Don't go away.
Don't go away. Jump by Van Halen. If you are just now joining us and haven't heard the story about the brown M&Ms, you should listen to this on Sunday or stream it. Van Halen and the brown M&Ms, great story. I love this story because Van Halen didn't trust people who said that they would set their stage up correctly. They wanted validation that people had read the contract and had gone through everything as it should be. They didn't want anyone injured or killed. And the reason it applies, the reason I like it so much is because most financial advisors, most investors who go to a financial advisor, all you get to depend upon is what the financial advisor tells you. Just like Van Halen or a lot of the people that went to set up, to perform, they trusted the stage managers to do what the stage managers were supposed to do. Van Halen had a 53-page book that spelled it out point by point, and they used the brown M&Ms to verify that the stage managers and the stage crew had read the contract and done what they were supposed to do. And most investors sit down with a financial advisor, they just trust what the financial advisor says. How do you prove? They never ask, how do you prove what the numbers are? How do you prove you can actually achieve what you're forecasting? Oh, yeah, you're using mutual fund track records and so on. How do you know that the manager is not changing? How do you know that things are not changing at the mutual fund? What control do you have? What control do you as a financial advisor have over the manager of the mutual fund or the bond fund or whatever is going on, the ETF? What control do you have? None. Zero. Zip. Can you depend upon something you have no control over? No. So it's not rocket science as to why financial advisors don't publish their returns on their websites. It's not difficult. We've been doing it for 30 years. And verifiable since I started Adams Financial Concepts. It's a verifiable track record. It's not questionable. It's all there. It includes every single client that does an equity account, from those who were with Adams Financial Concepts before 2005 to those who are still with us, to people that have been there just one full quarter. And it includes the returns of those people who have left for whatever reason, whether it's passed away, whether they decide they can do better somewhere else or whatever they do. All of those are included in that performance report. It's posted. We put it up on our website. We put it out in newsletters to say, this is how we do. Don't trust what we say. Look at what we do. There's the old saying, what you're doing speaks so loudly I can't understand what you're saying. We're there. And you hear the excuses about why financial advisors can't do that, because every account is different. At AFC, every account is different. Well, accounts start at different times. Guess what? Accounts at AFC started at different times. Well, accounts leave. Accounts at AFC leave. People die. Well, accounts are at different amounts. True? So are they at AFC. We have one child account at $500. Do you believe that? Not only that, the way in which we report, we take how each account does, what the performance has been during the quarter, and we average all those down so that $500 account gets counted at the same amount as a $4 or $5 million or $10 million account would be counted. We manage every account. Every account has different objectives and risk tolerances. At AFC, every account has different objectives and risk tolerances. No two accounts are alike. No two accounts have the same objectives. No two accounts have the same risk tolerances. Every account is different, and yet they're all grouped together. We have conservative, moderate, and aggressive accounts all put together. It's not a model. Every single account is custom made to the client. And if you look at how we did in the last 12 months, we were up 43%. Not bad for 12 months. Of course, we were down 50% before, so down 50, up 43. We're looking at new highs. We're looking at new highs going forward as well. So when financial advisors say they can't post the results, it's not rocket science. It doesn't take someone brilliant. It doesn't take special programming. It is, why do you suppose they don't want to post their results?
They're not that good.
Yeah. If they were really good, what would they do with those results?
Post them.
They'd post them. You could see them on their website. When you came in to meet with them, they'd show you what they were doing. Mm-hmm. And not every account has the same performance at AFC.
No.
Aggressive accounts will perform better than conservative accounts, for most part.
Except in a down market.
In a down market, they actually go down more than the conservative accounts.
Yeah.
Yes. And they recover faster.
Right.
They're up over 50%, well over 50%. So, what we're trying to do is customize each single return. And we want to compound those at a rate in which delivers the best performance to every single client. And we compare ourselves to the Standard & Poor's 500. Why? Because it's the hardest index to beat. There are over 3 million different indices. Funds find a group of stocks that are familiar, like maybe top-down approach, small Chinese companies, or African debt securities. If you're a money manager selecting small Chinese companies, how do you compare to other managers managing small Chinese companies, especially if they're not doing as well as the S&P 500? What they do is they'll say, and this is what financial advisors will say to their clients as well. Well, this segment made 3% last year. They don't say the Standard & Poor's did 10. They'll say maybe this outperformed its segment. It made 5%, and the segment made only 4%. They don't say the Standard & Poor's did 10 or 15 or 3. Because many managers, when they underperform, they lose clients. And there's a reason why the big firms sell the relationship, not the performance. Standard, sell your relationship. Make people like you. Don't get them to say, how well have you done? Prove it. No, they'll come in and say, how well have you done? I did really well. Yeah. But for money managers, whether it's a mutual fund or a separately managed account, ETF, if they don't perform well, what do? They come up with a new index. And when they can't beat that index,
a new fund.
Oh, yeah. And they come up with another index. And they'll do a 27-page financial plan for that. And they don't say, when financial advisors get together and they show the results, they don't say, if you'd invest in Spider with the dividends reinvested, your account would be $7 million instead of $6 million today. No, they pick a different index. They picked the international index, which was up only 5%, and you're up 7%. You would have been up 10% with the Spider. They'll say investment A was 2% better than the index. Investment B was 1.5% better than the index, and C was half a percent better than the index. They're all beating the index. You're doing really, really well. It's wonderful. But your portfolio is $6.5 million, and it should be $9 million. Or it's $600,000, should be $900,000. Or it's $60,000 and should be $100,000. They don't say that. It seems ludicrous to me to say that you're better off getting $600,000 rather than $700,000 because the risk-adjusted rate of returns are better for $6 million or $600,000 than $700,000. That's ludicrous. No matter how you cut it, $700,000 is better than $600,000. No matter how you cut it, $250,000 is better than $150,000. No matter how you cut it, $1 million is much better than $800,000. It doesn't matter what the risk rate of return is. I can remember I'm a mathematician by background, and I remember early in my career, doing a risk-adjusted rate of return on Microsoft versus Pan American. Pan American went bankrupt. But if you start those two stocks in 1983 and look, Microsoft has a much worse adjusted rate of return than Pan American had. Would you rather, 1984, which would you rather own? Microsoft or Pan American? Microsoft that went up, and Pan American that was supposed to be a flyer actually crashed and went to zero. Risk-adjusted rates of return are a statistical index which really justifies underperformance. All it does is say you took less risk. But the reality is $1.5 million is always better than $1 million. Don't go away. We'll be right back. We've got more to say. Van Halen, and we started the program talking about their 53-page contract, why it was so important, point by point, to go through why it was so important that they added that thing when they described what they wanted for munchies. They wanted M&Ms, but they did not absolutely want any brown M&Ms.
I think back to your point, though, Mike, about risk-adjusted returns.
Yep.
That it's easier to have a portfolio that's more conservative. No, I would say abstract, but sort of in the client's mind, that it looks to have a portfolio that's not going to have as much volatility. Mm-hmm. Just like we talk about dividend stocks, people assume dividend stocks are safer than non-dividends, which statistically is not true.
That's true.
Right. A stock is a stock and is subject to the vagaries of the marketplace. But I think it makes a lot more people comfortable to say my portfolio is not going to fluctuate. But you can't really say that because you don't know.
So it reminds me of, I met with a prospect the other day who manages a significant portfolio for an insurance company. He's the overall manager and supervisor of it. And he said, as an insurance company, they want to be conservative. Mm-hmm. And everybody said doing these dividend stocks would give you less volatility and an okay performance, not a breakaway performance. And so their equity portfolio, they had a lot of fixed income, but their equity portfolio was all in dividend stocks. Said they got crushed. Mm-hmm. The dividend stocks that were supposed to be stable and not much volatility did worse than the S&P 500. It just did much worse than the market. So when you look at things of the myth in our industry, saying this is conservative doesn't necessarily hold true.
Mm-hmm. I agree.
So I mentioned index, 3.73 million indices that are being used. 3.7. 438,000 were added in 2018, and that was the last year for which I can find data. How many today? Maybe there's 5 or 10 million indices. It's not to make things better for people to understand. It's the mushroom treatment. You know the mushroom treatment?
No.
Keep you in the dark and feed you.
Oh, okay.
A word that I can't mention on the radio. Anyway, so the question, it really comes down to asking questions. What's the financial advisor basing their recommendations on? Do they stand by their word? Do they have any proof that they're achieving the results that they're forecasting they're going to get? Do you really know how much you're returning? Do you know how fees are involved in your portfolio? I think it's much simpler to ask the question. If you ask somebody, how much money did you start with? How much have you added or withdrawn? How much have been the gains? What's the ending value? How did the market do during that same time? I think those are the key questions to ask. It doesn't have to be as complicated as brown M&Ms. It doesn't have to be a 53-page contract that spells out point by point. And something like sticking in absolutely no brown M&Ms and then checking to see if people read the contract. It doesn't have to be that complicated. It's how much did you start with? What did you add? What did you take out? What's the ending value? What must be the gains? How does that compare? If you started with the same amount and put it in the S&P 500, how much would it be during the period of time you've had the account? And if you find there's a huge discrepancy, it's not risk-adjusted rate of return. You know that it's bad advice. Can I say it's bad advice?
You can say whatever you want.
Whether it's bad advice or ineffective advice or whatever, you have to raise the question, you've lost money. It's an opportunity cost loss. It hasn't been a loss of actual cash. I can remember going to a conference and it was a day trading operation. They had a huge display and they claimed that every one of their clients had made money. Do you know what? I think they were true. I think that was a valid comment that every one of their clients had made money. The issue was not if they made money, it's how much they made. If a person started with $100,000 and at the end of 10 years had $101,000,
they made money.
They made money. They didn't make what they could have made. They didn't make as much as they made in a CD, but they made money. So it's asking the right question. How much do you begin? How much did you start with?
That's what I say when I meet everybody who's a day trader who tells me how much money they're making. I just ask, I said, they ask how we do. And I said, well, we do. I tell them what we do. And they say they do better. I said, okay, let's look at your Schedule D from your tax return. I haven't seen one yet.
So I remember talking to one day trader that said, I said, how well we did. He says, I do much better. I said, really? I said, so what did you do? 40%. That's what I've averaged. I said, really? He said, why don't you let us manage 100,000? I said, well, I only have a couple 100,000. I said, what'd you start with? Well, 8 years ago, I started with a little over 100,000, I think.
40%.
40% per year for 8 years?
For 8 years? That would be, that's money with 100,000, just my head, you double in about a year and a half. So 8 years, so he should have had, 200, 400, 800, he should have about 1.6 million.
Yeah.
Or more, actually, more like 2 point something million.
So, part of the question is people don't know how they're doing. People don't sit down and look at what they started with, what they've taken out, what they put in, what the gains have been, and how it would have worked with the market, just the Standard & Poor's 500. It's not difficult. It doesn't have to be the brown M&Ms. And yet, the brown M&Ms is an effective way to see if somebody read the contract. Looking at what you began with, what you added, what you took out, what the gains have been, and what the ending balance is, and comparing it to the Standard & Poor's 500 tells you, are you getting your money's worth? If you started with 100,000 and 10 years later have 101,000, yes, you've made money, but you sure haven't let an advisor, the advisor sure hasn't earned us 1% or 2% or whatever they're charged. That's the point of the whole thing.
But in actuality, if you got the conservative account with inflation, you actually really are. In real terms, you're losing money.
Correct.
In nominal terms, yeah, it might look like you made 5 or 6%, and you factor out inflation, and your return is 1%, and your advisor's taking 1 or 1.5%, so you're losing money.
Yep.
And people don't think of it. They don't think that way. They look at absolute values and go, "Oh, wait, I made money. Really? Did you really make money?
Did you really make it after inflation's counted?"
You don't. No.
No.
And that's not going to show up on your portfolio statement.
That's correct. A lot of portfolio statements don't show what percentage you made either.
Mm-hmm.
So anyway, that wraps us up for today. Brown M&Ms. Keep that in mind. Keep that very much in mind. And keep in mind, how much did you start with? How did you add or withdraw? How much were the gains and what was the ending value? And how does that compare to the Standard & Poor's?
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.